well tips that I've got for you tonight because I definitely wasn't early to tonight's live show. So what an introduction that might be. Good evening, MLS. Good evening, Umbrella Lemming / Gary. How are you going? Um, Welcome to Selfwealth Live. My name is Owen Rask. It's my absolute pleasure to have you with me. I was just telling Rob, who's joining us tonight from Selfwealth, that I had all day to prepare for tonight. And yet I still managed to run overtime trying to put together some charts and these types of things. So hopefully it's a bit of fun, but apologies for my tardiness. Owen, you've said, here's a question. Will the RBA use the banking crashes in the US as a perfect excuse to pause interest rate hikes? I don't know. I feel like that's a good quiz. If you want to do a poll, maybe, will the RBA pause interest rates from here? Or will interest rates keep going higher? Or will interest rates fall from here? That's the probably $1 billion question right now. And I don't have the answer. Unfortunately, as much as I would love to say that, I might have the answer, I actually don't, Owen. So apologies if that's what we all came here for tonight. Okay, so I've got a few slides to get through, and I hope that they're informative. I'm trying to do a bit of a session tonight where kind of everyone can benefit, whether you're in the Rask community, in the Selfwealth community, or in both. So I'll just straighten up this screen a bit here. There we go. But before we get to that, as always, I should do our disclaimer. And actually, I should put it on the screen so we can all remember it. So just a quick information warning. This video contains general financial information only. It does not take into account your needs, goals, or objectives. So you shouldn't act on the information until you've spoken to your financial planner. My name is Owen Rask. I'm the founder and the sole director of the Rask Group. We are a corporate authorized representative of Waddle Partners, and there's the AFSL 383169. You can find our FSG, that's a financial services guide, on the Rask website. Final caution is the views expressed in this live stream are solely those of me and do not necessarily reflect the views or opinions of Selfwealth, which is a really important one because, hey, it's just me, my opinion. So I can see a few of you have already jumped in the chat. We've got Paul, Jason, Owen, Chef Circle, Chandra, Kant, here we go. Warren Buffett's latest shareholder letter. Okay. Everyone's here. Martin, Soul Soul director. I think it's SOUL, Martin. It's taken my soul, that's for sure. So here's my dad joke for this evening. The Batmobile won't start, says Robin. Batman says, check the battery. Robin says, what's a Terry? That's my very poor dad joke for this evening. And you're welcome. You're very much welcome. And it's definitely Pilbara over in WA. I am in Victoria, so I don't know how to spell that or how to speak it. What would be cool? 2 chat windows, one for us to bang on in and one to ask actual questions. That would be nice. Thanks, YouTube. Owen, maybe you should take a job as like chief of product at YouTube. I think they're hiring, or maybe they're firing. It's a groan from me, says Rob. That's a 7 out of 10. Chef Circle 1, Jason 1. All right, I'm hitting the mark tonight. Okay. So tonight we're talking about inflation. Hopefully this doesn't take the whole session so we can talk about some stocks and that sort of stuff. I know you've got some questions. The more you hate the dad joke, the better. Very groan worthy. Okay, I'm getting lots of positive energy tonight, guys. I do like this. Minus out of 10. Oh, geez. Okay, Owen, here we go. Why did the wombat take toilet paper to the party? He was a bit of a party pooper. Ah, I see what you did there. Nice. Okay, so hopefully we can get through these slides and a bit of this inflation talk, and then we can maybe talk about some stocks or some ETFs and things like that. So if you don't know why inflation is such a big problem, I'm going to set the scene for you. So I've got a list of ways that you can beat inflation, but we'll get to that in a minute. But why is it such a problem? And you'll see here I've basically analyzed a few different perspectives on why this is such a big problem to everyone. And this little snippet here, just in case you don't know, this comes from the Reserve Bank website, the RBA's website, and it shows that inflation across everything is 7.8%. So that can include a bunch of different metrics. It includes a basket of different products and different services. But here you can see a screenshot of Commonwealth Bank's term deposit rates. So this is over 12 months. Commonwealth Bank would pay you about 3.85%. Assuming you're not in retirement, you'd be taxed on that as well. So if your tax rate was 30%, you'd be getting closer to 3% after tax. Meanwhile, the cost of everything that you are buying is going up at 7 to 8%. So here's a big thing. And Chef Circle said, inflation equals Germany equals World War II. Exactly. So another way to look at this is that wages have only gone up 3.3% in the past 12 months. And that's data from the ABS, again, versus inflation of 7.8%. So the same wage that you had this time a year ago is now worth, in effect, 7.8% less because prices have gone up. And your wages, if you didn't get a pay rise, well, you're the full 7.8%. If you did get an average pay rise, it might only be 5%, but you're still going backwards. And finally, if you look at mortgages in Australia, the average mortgage here, according to Trading Economics, is around 6.26%. I don't know if that includes the most recent RBA increase. So again, we can see that the interest rates have had to increase to try and slow down the economy, which is, by the way, like rampaging up. The mortgage rate, you can see just a year ago, the average mortgage was below 4%. So huge difference. And I'm just repeating a lot of the stuff that we already know. But if you think about this, even though we say now, for the first time in probably 10 years, savers are being rewarded more than spenders or investors, even savers are going backwards. And then here, in terms of employees, are going backwards, assuming you didn't get a pay rise. And here, people who own property who have any sort of debt are going backwards in a big way. And so I think it was Chef Circle just mentioned the problem with this. But here's a snippet from the RBA. As we know from the 1970s and 1980s, high inflation is damaging and undermines people's living standards. While the circumstances that gave rise to the current inflation are different, the effect of inflation is the same. It erodes the value of savings, puts pressure on household budgets, and hurts people on low incomes the most. And the economy doesn't work well when inflation is high. It is harder for businesses to plan, and people spend time protecting themselves against inflation rather than on more productive activities. And if inflation becomes ingrained in expectations, it requires higher interest rates and a large increase in unemployment to get it back down again. So you could probably see this is having an impact, because some of the things I'm going to tell you tonight, in fact, most of them have to do with spending less. And if we all follow these steps, we'll all spend less, which means businesses will struggle more. And so this is the kind of a cycle that we have to go on to kind of clean the system out a bit. So if CBA pays inflation rate, then home loan rates would be 12%. That's right. So Jason, if said CBA interest rates for term deposits could highlight where the bank thinks the RBA may go. I think CBA is like my employer, pay rises under inflation. So the term deposit rates, I'll get to that in a second, but there's probably a genuine case to be made for actually locking in some term deposits right now. Not all of the cash, but some of it, because inflation could actually fall quicker than people expect. Now, if you've locked in a term deposit rate for 3, 4, or 5 years, perhaps, maybe that gives you a buffer. Now, there's also a big risk in that inflation keeps going higher, and you've locked in a term deposit at 4% when you could be getting 5% in 6 months or something like that. But I think one of the things I'm noticing is that the big banks, to your point, Jason, is that the big banks on their forward term deposits, so their longer dated term deposits, it looks like they're starting to come back. So meaning that they're starting to offer lower rates to savers. So that's quite interesting. Okay, so let's get into the 11 ways. And before I do this, if anyone can tell me what a bachelor's handbag is before I get to the slide, you get extra brownie points from me. I'll give you a crisp digital high five. You get the brownie points for being the one to tell me what is a bachelor's handbag. Tell me what that is. It's a bit of fun, and I'll cover it in just a second. But so let's start at one of the things that Warren Buffett has to say. Warren Buffett is the wealthiest pure investor in the world, right? And he says one of the best things you can do, even though he's a fantastic investor, one of the best things you can do is actually just be exceptionally good at something. So he said this recently, actually. He was asked this again and again and again at the annual meeting. And he said, be exceptionally good at something. And for me, this is the key thing, is your job, if you are employed and you're not retired, should be your number one priority right now. So making yourself indispensable at work is clearly a key to any type of career progression. But now, when businesses might be struggling, or when other people may be laid off, now is a good time to do that. And so, in 2004, Warren Buffett made another statement about why investing in yourself is actually such a powerful way to beat inflation. And he said that basically, when you invest in your education, you're using today's dollars. So we know that inflation is always present. It's like between 1 and 6 or 7 or 8% right now. So inflation and the cost of things is constantly going up. But the cost that you pay for your education, for example, if you paid for education in 2004, you're making today's income based on what you had spent on your education in 2004. So making yourself incredibly good at something is not just good for right now in terms of higher salary, it's good for many years into the future. So Ron, Caroline, Eve, Peter, you got it all correct. It's a barbecue chicken, and I'll explain that in a little bit. It's a barbecue chook. It's a good one. So the first thing is making yourself exceptionally good at something, and that can happen in multiple ways. Number two is something that has been kind of bandied around recently on social media and whatever. But one of the best things you can do to insulate yourself against risk is actually to have multiple sources, like of redundancies in your life. Like an engineer would say, have redundancies. And so multiple sources of income is clearly like a focus. We did the passive income series in January, the most popular mini series we've ever done at Selfwealth Live. And it's clear that people are interested in a second source or even a third source of income. Multiple sources of income is it's a tried and tested way to insulate yourself against economic impacts. There was an IRS paper here over the top, how tax returns show that the very rich are different from you and me. And in a loose roundabout way, it emphasizes that millionaires tend to have 7 sources of income. So it might be, dividends, it might be a business, it might be rental income, it might be a second job, it might be a third job, something like this. At the buffet, says Dos, Buffett goes for the bachelor's handbag. I can imagine, but he's not a bachelor, is he? So maybe not. So the IRS found that, the average millionaire has 7 sources of income. So consider your own income. I spoke to an investor last week. His name's Mark LaMonica from Morningstar. And he was saying that his focus as an investor is not actually to do better than the market. His goal is not to outperform an ETF or do better than average. His single goal is to invest in things that pay him income so he can use that income to afford a holiday, to eventually retire on, and so on and so forth. So he's not interested in the capital growth per se. He's interested in the income that comes from the portfolio. So that's probably really relevant right now when inflation's going up. So number 3 is hack the spending. Now, this is obvious. I think, Eve, you just said that some grocery prices have gone up so much. I eat a lot of cottage cheese. Well, that's pretty healthy. Good on you, Eve. 500 grams of Coles cottage cheese was $1.90 in 2019, $2.90 at the end of 21, and now it's $6. You know what, Eve? I drink, I sound like a snob when I say this, but I drink A2 milk. You would know A2 milk. I'll log in. So accept risk and continue without that. So A2 milk is obviously the company that's on the ASX. I think you might even own this one, Ava. Was it you, Eve, that you said this? I buy A2 milk. So I'm a consumer of A2 milk products. And I tell you what, the share price hasn't done half as much as the price of a 2-litre A2 milk, light milk, by the way. I like the light milk. I think I'm paying about $6 or something like that. Snob indeed, says Jeff Circle. Seems like a waste of money. Well, you know what, Christopher? It's good for, and air quotes, if you can see me down the bottom, it's good for tummy health. So tummy health. That's what I've been sucked into. Not sure about the other science. Anyway, so hack the spending, especially if it's discretionary, or at least be choosy. So here we can see the price of food is going way up. Some food in particular is going up incredibly fast. Obviously, we know the lettuce story and all that stuff. But if you just look at dairy, the inflation for dairy has never been this high since this chart started. And if we look at cereal, higher than ever. Meat, not too bad, surprisingly, but other foods such as eggs, jams, oils, and snacks, etc. So one of my co-hosts on the Australian Finance podcast, some of you will know her, Kate Campbell. She was telling me in anticipation for tonight, she said one of the best money-saving hacks she's had recently is actually going to the farmer's market and buying these things. Because the price of all this stuff has gone up at supermarkets, you can still buy from local vendors like farmers and that sort of stuff who haven't put their prices up like this. Maybe they haven't realized how high inflation is, and you can go and buy that. Even things like fruit mongers and butchers directly may not be as impacted. And here we go. Here's the Bachelor handbag. Now, I hadn't heard of this until recently, until Effie Zahos came on one of our podcasts. Kate actually interviewed her, and she was talking about the Bachelor's handbag. I'm like, what on earth is the Bachelor's handbag? And it's a roast chicken. And she made the point that you can buy the chicken, sometimes on special, at the end of the night, and then you can use the leftovers for the next meal the next day. And presto, you've got a few more there. And that's it. So Bachelor's handbag, congratulations to everyone that got that right. I definitely did not know what that was. So do you think that some are using inflation as an excuse to artificially increase prices? I don't think so, Jason. I don't think so. Maybe some of them. You should definitely set up 2FA on that Selfwealth account, says Sachin. Well, Sachin, you will be pleased to know that's a demo account. I use that just for the lives, and that's about it. So $6.46 for a 2 litre of A2 milk. Used to be under $5, says Monica, but it tastes better than the rest. Well, Monica, amen to that. I tell you what, yeah, I'm still buying A2 milk, and I'm even more of a sucker because I'm using Coles online, and I don't even check. I just go straight to A2 milk. So I'm paying that loyalty tax. You know what I'm saying? Another good tip when you shop online is not when you sort for items, like the supermarkets kind of just put what's best, what they think's best in front of you. But you can actually do the settings when you shop for Coles or Woolies online, if you do that like I do, and you can shop by price per gram, like if it's say like food, or price per unit if it's toilet paper, and you can sort by that. So you can immediately go to the lowest price or highest value one. And that's what I do, and it actually it pays for itself. So someone somewhere is artificially inflating prices due to inflation. Yes, Sketchers, I agree. Nothing has got more expensive except for people charging more for it. Perhaps unless you think about like overseas inflation, so like shipping containers and that sort of stuff. Although we did see the Baltic. I don't know if you guys watched. You guys probably don't. We have better things to do. So this index here actually shows you the rates on shipping containers, right? And if we zoom out, if you actually look, the rates for sea freight have fallen drastically since COVID. So this is one thing that is a very strong signal for investors that maybe the price of logistics and shipping and all that sort of stuff is coming way down. And that could be a sign that inflation will eventually fall. Because if it's cheaper to get products again from China or from wherever, even like commodities from Australia going overseas or whatever, then that means that inflation may start to come down. So here we go. Update your budget, number 5. And I've got creating wealth is a marathon, not a sprint. This is one of my oldest charts that we designed when I started the Rask business way back in 2017. And it just shows kind of like the whole illustration of what investing is and what it's and how it links to saving. And so we've obviously got to earn more and spend less. Those are the 2 key variables on this side, and little bits, lots of times. One of the things that people get really disheartened about, I had someone write into our podcast the other day, the Australian Investors podcast, and he wrote in and he was really disheartened because we said, if you're going to have money now and you have a huge mortgage, don't invest the money, pay off the mortgage or set yourself up. And he said, well, Owen, I was really disheartened by your answer to my question because I really just want to keep investing. And one of the things you can do right now is, instead of trying to fall into the all or nothing approach, is just invest less, but keep doing it. So even if your mortgage has gone up, $1,000 a month like mine has, or maybe even more, chances are I've heard some mortgages going up $2,000 a month. If that's you and you can't afford to invest $2,000 a month, maybe you can only afford to invest $500 a month, then that's the key thing to do, is just to keep dollar cost averaging. And I didn't have enough time, but I was going to bring up that other chart that you guys know that I always throw in, which is that timing the market doesn't really matter. It's actually just about continuously adding money to the market and letting it compound. Number 6 is find companies, and now we're moving into investing, guys. So now we're moving into investing and away from like the savings theory. So find companies with low capital requirements. Last week we had this fantastic conversation. To be honest, last week's Selfwealth Live was my favorite Selfwealth Live probably ever, because what we talked about last week was how to build your own investment process and how to follow a strategy that works for you. I mentioned Mark LaMonica just before, who invests in income-producing stocks. So that's his strategy, and he follows that, and I'm sure he has a way to do that. But last week, we talked about how to take the whole stock market and break it down into a list of companies that you want to research. Obviously, you can still do ETFs if that's what you want to do as well. Not saying you have to pick one or the other. And we talked about how to do that end to end. Well, one of the things that I do in these types of markets is I always look for companies that have low capital requirements. Now, if you don't know what that means, basically what it means is you don't want to invest in a lot of companies that have to spend a lot of money to make a lot of money. Because the cost of money, i.e. inflation and interest rates, are going up, if a company has to spend a lot of money to make a lot of money, that's more expensive. So we want to find companies that don't spend a lot of money. And so companies that would fit into this camp are companies like Amazon, right? Like Amazon is a website, right? It's also got, forget all its other technology division, but it's just, if you think about it as a website, what Amazon worked out really early in the 2000s was that as an e-commerce retailer, it can take people's inventory. So say like you're Sony Electronics, right? It can take a Sony Electronics TV and put it in the Amazon warehouse ready to be shipped to a customer, but that's not Amazon's inventory, right? So what happens is a customer goes onto the Amazon website, buys the TV, Amazon ships the TV from Sony, but it's from its own warehouse, right? But here's the key thing, is Amazon takes the money there and then because you pay for it online. So it takes the money within one day. Visa remits the money to Amazon's bank account and presto. Sony had to pay to put that TV in the Amazon warehouse because it had to pay to create the TV, design the TV, and ship it to Amazon's warehouse. But then Amazon can hold on to the money that it's collected upfront from the customer for, say, 60 or 30 days, depending on the payment terms, and then send the money back to Sony. Right now, this thing it sounds a bit geeky. But what it means is that Amazon got rich off other people's money. So it didn't use its own money to grow its business. It used other people's inventory. And so I tend to avoid companies with high inventory. So like a lot of retailers, I tend to avoid companies with lots of debt. In these types of market environments, debt's going to be more expensive. I also tend to avoid companies with thin profit margins. Imagine if you have a company, right? Imagine if you have this company. Just imagine this company in your mind. And it has a profit margin of 5% at the beginning of 2022, so about a year ago. And then your costs go up 7% or 8% with inflation, and you can't pass those extra costs on to your customers. We've got no profit left. So the key thing here is we want to find companies that don't rely on a lot of inputs. And that's probably the thing that I kind of wanted to get off. So, Owen, you've said airlines have to spend a lot of money. Yes, and they finance their airlines as well, which means they're even more expensive than they would think. So Stevie said best episode so far. Exactly, Stevie. Best episode of Selfwealth Live so far. No, I genuinely loved that episode last week. So when we talked about, if someone wants to paste it into the chat, I'm sure Rob or I will put it in the description below after the episode. But that episode on investment process was by far my favorite because we covered so much and we tied a lot of loops together for a lot of people. So I know there's been a lot of comments here, so I'll try and keep up, but I'm struggling. I can see some good comments from Sketch Oz. So Pilbara, yeah, Mike. So Pilbara is now cash flow positive, right? So that's one thing. We should make a browser extension called the Rask button. It searches pages for buy and replaces with would Owen click it. Okay, so let's move on to the next thing. So if keeping capital costs were low is a priority, the opposite of that is we want companies that can increase prices. There was an article I read in the ABC a week or two ago. I think it was the ABC. I'm about to throw them under the bus, so apologies if it wasn't the ABC. But there was an article from someone who said that company profits are the only reason inflation exists. And they were trying to insinuate that companies reporting profits was the reason inflation was going up. Now, if in my opinion, that sounds somewhat of a conspiracy theory, so I didn't really buy into it. And I also have a pretty good understanding of how economics works. So I didn't necessarily buy into that. But there's a belief that companies raising prices is the reason that inflation exists. So, I mean, sure, they might cause some of it, but all of it was a stretch. And the reality is, if a company doesn't raise prices by 7.8%, then the business is probably going to go backwards, right? Because the employees also want more wages, which was 3.3%. So companies need to be able to pass on prices in order to grow. And I've got a few things on this which might like ruffle a few feathers in a minute, but this chart you guys may remember from very early days in Selfwealth Live. And what it actually shows, right, is it shows, and it's from the Gorilla Game book, if you've read that. Finally caught one live, albeit right at the end. Harry, you are not right at the end. If you know me, don't worry, mate. You could be here for a while. It was ABC. Thank you, Owen. Okay. So in this chart, what we can see here is that a company, as it grows, can actually get more valuable. And what tends to happen is as a company gets bigger, it also tends to get lower risk. Now, this is a key insight I want you to remember, is that a lot of people think when a stock price goes up, they should sell. You know that old saying, buy low, sell high? I don't believe that, because a lot of the times when a stock price goes up, it's because the business is performing well. And if the business is performing well, I don't see the reason why you would sell it. Now, this chart illustrates this, and it kind of captures all of these things in one chart. And let me explain it. It basically says that, like, a company that has a strong competitive advantage right now is this, this dark blue here. Now, over time, that company can actually capture more value, which would be this light blue, and that leads to higher returns. So if a company gets more dominant in its industry, it will capture more of the value that's created. And what that does is a few things. One, it obviously increases your return. Two, it makes the business more dominant. Because it's got bigger, it becomes more dominant. And because it's more dominant, it becomes bigger. It's this thing that just feeds on itself again and again and again. And that's what they've illustrated here, or we've illustrated in this graph. And the final thing is it becomes lower risk because it's a bigger company. So we want companies that are able to pass the prices that they're copying on to their customers and say, we're getting higher prices, so we're going to push them on. Yes, we'll record higher revenue in time, but this is going to be happening when all of the competitors are falling away and are struggling. And you guys know I've said this before, but there's this old CEO saying that you never waste a good crisis. And what that means is basically, if you are a strong business with a good balance sheet and you've got a good product or service, when the market falters is when you should be investing more, not less. And yet a lot of CEOs don't do that. So the mantra is like, make the most of it if you can. And I'll get to some companies in a second, by the way. So a few more things. Number 8 is normally what you'll see in the media when inflation is high is that you should get out of bonds. So many of you will know that my favorite Australian bonds ETF is this one right here. And over the last few years, as inflation started, so that when was that? Like around here, back of COVID, you can see that as inflation started, the price of the bonds fell, right? And the reason that they fell was because interest rates were going up. And bonds and bond prices, like think of this as the ETF, and interest rates, they're like a seesaw. They're on the opposite side. So as interest rates go up, bond prices come down. So that's really important to remember. And so we've seen interest rates go up. So bond prices have fallen, right? We can see that here. My favorite global bonds ETF is this one right here. And again, this doesn't have as long a track record in an ETF form, but you can see here that this one has fallen as well. There's a lot of US and European bonds in this thing. So you can see that. So what about short duration government bonds, Christopher? Good question. Good question. I can get to that in a second. SVB didn't listen to Owen. Exactly, Chef Circle. So that's a great point, Chef Circle. I should have brought that up. SVB, for those of you that have been reading the financial news, that's a bank in Silicon Valley that collapsed. The reason that it collapsed is because they bought heaps of these. They used what cash they had and they bought bonds like this, exactly like this. And then the bonds fell in price and then they had to sell them at a huge loss to then get the money back for their customers. And they couldn't do it at the price that they bought them for. So then they had to do a capital raising by trying to sell shares. And then the capital raising fell through. So then they ended up with a dodgy balance sheet and unable to get cash in the door. Hence, here we go. Didn't hedge against high interest rates. Exactly, Jason. So they kind of just thought, we'll just buy bonds. What a silly decision that was, honestly. Like, bonds were already near zero. That couldn't go any lower. Okay, I'm just reminded of that Super Trooper scene at the start. So anyway, bonds fall, and now people are freaking out. They're thinking, oh, bonds are a bad investment because our monkey brains are saying recency bias. Look how bad bonds are. If you only look at the 1 year chart, you could be like, that's a terrible investment. But now I think it's actually the time to start changing that thinking. So if you've got a part of your portfolio exposed to cash or gold, which I'll get to in a minute, maybe now is the time to slowly start wading that money back into bonds because interest rates won't go up to forever. Benny, bit late today. No worries, mate. Good to have you with us. So I recently bought more bonds for one of our model portfolios at Rask. And I'm considering there's an email going out to our members tonight, actually. And it's a very long email, so be prepared if you are a member. And it basically says that I'm considering putting more of our money into bonds. Now, I want to be very careful. It's not an all or nothing thing. You don't just go from no bonds to heaps of bonds. That's crazy. You just do a little bit. Gary, you got it. You just do it a little bit at a time. Okay, so I didn't actually get the slide up that I wanted to. I was trying to find the slide for this, but I didn't have the full slide. So avoiding bank shares. So some people will be like, okay, not only have you not finished the slide, but you've left us kind of in anticipation. So one of the things that happened with the banks, right? One of the things that should happen with bank stocks, and hear me out, one of the things that should happen with bank stocks is that as interest rates go up, the big banks, the good banks, should make more profits. Now, we've seen CBA come out and say that they've made more profits, and we can go net interest income for that. So we can see CBA is making more money, right? And then everyone in the media is like, oh my God, it's such a profitable bank. It's making too much profit. That's why inflation is so high, even though not knowing that CBA really had no control over that. Anyway, so at the end of the day, CBA has made more profit, but the percentage that they make hasn't been as strong as it kind of needed to be. So what I mean by that is you might remember in the past where I don't think we have it here in Selfwealth. You can use it. You'll be able to find it in Ticker if you use the Ticker software, that one from last week. I'll see if it's got it in there. So the thing to keep in mind is that for every dollar of capital that a bank lends out, it needs to make an increased return from that. So if I lend you $5 and then you pay me back $6 in interest and capital over time, I make $1 profit. Now that actual dollar of profit has slowly been squeezed over time because the banks haven't been able to continue to widen that margin. We call that a net interest margin. I'm going to see if I've got it here. I actually don't have it here. Let's try here. The banks haven't been able to do that. So this will give us a proxy of it. So this kind of shows you here the what we call net interest margin. And this is basically saying for every dollar that the bank lends out, how much money do we make in profit? And you can see it's hovered around about, if we go back further, it'll be much bigger. You can see it's hovered around about 2%, but recently it started to fall. Now, this is basically like saying that even though interest rates have gone up and the banks have recorded a bigger profit just because interest rates have gone up, the per dollar amount that they're making is not as good as it should be. And this might all sound a bit confusing, but basically what we've had is a massive increase in interest rates, and the banks haven't been as profitable as everyone was expecting. And that's why I think we could start to see weakness in bank shares. We might actually see banks, they'll still be profitable, but as default rates go up a little bit and whatever, it might not actually be as profitable as people expect. So even though I say avoid bank shares, I'm not saying sell out of them. I'm just saying maybe just be mindful of it is probably a way to think about it. Okay, I've got a few more and then we can just go free for all on questions. This is quite controversial. So if we look at the returns from gold ETFs and gold prices, gold hasn't really done what it said. So normally you would invest in gold if inflation is going to be really high and interest rates going, because the uncertainty means that more people will buy it. Let me just go QAU ETF. I was looking at this today. This is the currency hedge ETF from BetaShares. It's quite a good ETF for getting exposure to gold. But if you look at the returns during a period when gold prices should have been providing that cushion that they're normally used for, it went the other way. It went down. So it did exactly the thing that it shouldn't have done at the time that it shouldn't have done. And so I think this is only one sample size, but we can see like an investment in gold over the last little while has not paid off as well as people would have thought. Now we might be able to get the gold ETF from GlobalX because this one is actually in US dollars. It might have benefited a bit more. This is what full disclosure, I currently own shares of this. Yeah, so this has actually benefited from the higher US dollar. So we can see it has actually done better, but still kind of like that's pretty good, 5.5%. Probably not as good as I'd still like, but it's done a decent job. 10% of my SMSF is gold, and for me, it is treated in the high risk percentage of the portfolio. Interesting. Paul, you've said 0.2% of it, 0.27% over 10 years. Why would you invest in that? Well, Paul, the reason that you would invest in that, and I'll just digress from the conversation for a minute. So this ETF is not currency hedged, meaning that you get US dollar gold. Now, the other one, this one is in Australian dollars because it's currency hedged. So the difference is between the two is really just the difference in the currency movements. So that's it. That's right, Martin. So gold ETFs, hedged or unhedged. And that's the key difference. So those are the two bigger gold ETFs in Australia. And that's the key difference between them. So for me, like gold, maybe the gold ETF from GlobalX has done what it should. The other one probably hasn't. And because we've probably seen a change in currency, I just think now for me personally, now that bonds are starting to offer interest and bonds are starting to look more tempting, for me personally, the usefulness of a gold exposure is reducing, especially if inflation doesn't persist. Okay, so go on the offensive. This chart here shows the Dow Jones Industrial Average since the 1980s. And what you can see here is you can see like the Asian crisis, you can see the dot-com boom and bust, you can see the GFC, you can see the coronavirus crash, and you can see what's happened recently. Now, the key thing to note is that as you zoom further and further and further and further out, the bear markets become smaller and smaller and smaller. Many of you know this one, which I'll paste into the chat. Owen, you said ever looked at PM Gold? Yes, I've looked at PM Gold, Owen, and it's It's an interesting ETF, PM Gold, Owen. So there's a reason a lot of financial planners don't use PM Gold is because it doesn't actually, it's a bit nerdy of me to say this, but it doesn't actually give you exposure to physical gold. So that might be a bit weird. So the way PM Gold works is it doesn't actually give you the exposure to gold bars in a vault somewhere like BetaShares or GlobalX does. What it does is it actually gives you a right, like a contract, a right to gold at Perth Mint, insured by the West Australian government. So it's a little bit different. Anyway, so here we can see that, like, again, we can see different blips and whatever, and we can actually look at falls greater than, say, 10% in the stock market. We can see the falls that were greater than 10%, the falls that are greater than 15% and 20%. You can see that the recovery is this light blue, and the fall, the period for falling, is actually in the red, although, sorry, the kind of like pastel orange color. And basically what this tells you is that the fall is quicker than the recovery. Now, we might be in a situation where perhaps we're starting to get to the bottom of the fall. I don't know, but maybe we're getting to a period where now is the time to start thinking, well, the stock market's fallen. Things might continue to fall, but I mean, hey, maybe prices are actually better. Now, this is not a prediction. I want to be very clear. I do not make predictions. And as Rob's disclaimer went before, my disclaimer is that anything that's obviously on the show is general information. But for me, I think about a few things. One is that if I was going to be a buyer of companies, I'd want to do it when prices are lower. Number two, I'd want to also buy when people are more scared and fearful. That seems like a better time to be buying these things. And number three, if I've got a long-term focus, for me, the short-term volatility can be stomached with a long-term outlook. Now, that's not for everyone, and it might take a long time, and it could be wrong. It's one of those things. Paul, you said, I can remember when gold was around $300 an ounce. I know you know this, Paul, but there was a heap of debate around gold. There were gold bugs, gold bears, gold everything in between. And Warren Buffett's quote is, investors who bought an ounce of gold in 1920 still have an ounce of gold today. But someone who bought a business back in 1920, and if that business is still going today, it would be a heck of a lot bigger. And they probably would have received dividends in between. And that's why a lot of it is, Paul, you said Perth Mint is in the news for the wrong reasons. I did not know that. I did not know that. Storm in a teacup, Perth Mint comment was gold. Interesting. Okay, so that basically brings me to the end of the slides. So I'm happy just to go free for all and answer questions because, we don't often get time before 7 o'clock when I've got a bit of things to talk about. So if you have any questions, please send them through. Paul H. had a prospector tell me he used to liken prospecting to picking up $20 bills off the ground. Now he likens it to picking up $50 bills off the ground. Interesting, Paul. So you're saying that, well, because the gold price has gone up, it's now more profitable for someone to do that. Well, that's fair. If you think about the quality of gold reserves in the world have definitely fallen drastically over the past 50 years because more gold has been mined. That's why we're mining existing mines now rather than a lot of new tenements. Interesting. Okay. EVN microscope, please, says Mike. EVN, you mean Evolution Mining? I'm assuming you mean this business, Mike. I can take a quick look at this. So obviously this is a mining company that sits right next to Northern Star Resources. I've always preferred Northern Star Resources. So just as a general take, I'm going to give you a quick one because, as you know, Mike, I don't necessarily invest a lot in gold mining companies or in resources companies. I do know a few investors who do that. One of them who I was actually, I think I didn't get back to him. I was supposed to have him on the show tonight. I can bring a gold and mining resources expert on the show if that's what you want me to do, Mike. He has expertise in this. I do not. But some of the things that you just got to be mindful of are obviously just the profitability of mines going through time. Now, normally when you click on a revenue versus net profit for a mining company, it does not look anywhere near as stable as this. So there's obviously something going on here in a good way. So quickly, my eyeball says, revenue going up, profitable, which means that maybe they've got good assets, right? Another thing that I will look at, as you guys will know, is this. So this basically shows you the number of shares outstanding in a company through time. And the reason I always do this if I'm trying to learn about a company is I want to know how the business was funded. A lot of businesses will just sell heaps and heaps of their company shares to try and raise capital to support their growth. And then obviously you'd have to look at total debt as well. I don't normally rely on third-party data for that, but let's just have a quick look and see what's in here. So total debt. It looks actually, so total debt is a very subtle shade here that you can't really see. I'll see if I can bring up a different one. Get rid of that. Let's go total long-term debt. So yeah, we can't really see it because of the shade of color that's being used. A mining expert would be awesome, Owen, says Caroline. Please, Owen and Rob, smiley face. We can do this. Yeah, we can do this. So evolution mining, some things that I would look at, Mike. One is, if I'd go into the news and announcements, I don't have it here right now, is just look at their gold reserves and look at the grade. Because the grade of gold reserves in their so it's the resources and reserves. Reserves are the one that I'm talking about. Look at the reserves that they have and look at the quality of that gold. And look at the quality of that gold through time. Because if they're JORC, if they've been properly audited, those results, those drilling results, it will give you a great estimate of what the costs of the mine will be long into the future. So we're looking for the reserve quality, which then tells you roughly what the cost would be. Because if it's better quality, it means typically that a mine can produce more gold without, going through too much dirt, basically. Another thing is like, what type of mine is it? That's one that I would be looking at. So what we can do that, says Rob. Yes, we definitely can do that. We can get an expert on board. So Excite Max 6, you've said, I'm late to the party, but what bonds are you interested in? Excite Max, we don't obviously give personalized advice on this, but I just pointed out the IAF, or the iShares Core Composite Bond ETF, which just had a fee reduction, and the Vanguard Global Bond ETF hedged. These are the two that are on my watch list, just so you know. Would you put Macquarie Bank in the same boat as the other big four banks, Benny? No, I wouldn't. Macquarie's quite a different beast these days. Macquarie does make more money from its lending book nowadays, but in terms of the overall business, it doesn't. It's not as dependent on retail banking as, say, Commonwealth Bank. I still think I would, for the record, I'd be happy to hold Commonwealth Bank shares in a portfolio. I definitely would. But it's just maybe not, just don't expect the same returns that we've had in recent years from something like Commonwealth Bank. Maybe we do, maybe we don't, but it's just one of those comments just to exercise caution. Now, Macquarie Group is obviously a business that will grow a lot better than the other banks because it has international exposure. It does investment banking as well as retail banking. So I think Macquarie Group has one of those track records where, if I go to income statement, Macquarie Group has one of those track records where it's reported a profit for over 50 years in a row. So meaning that even during the GFC, when it got absolutely slammed amongst all the other investment banks, it reported a profit that entire time. So it's also paid dividends over a very long period of time. Let's have a quick look at analyst forecasts for, maybe we'll go revenue, and we can see earnings. So investors still expecting strong earnings from the business as well. So that's what I would say. What is a bond, says Super B? A bond is a contract. A bond is like your bond. I have a bond with you. A bond is a contract, and it's typically with the government. Not always, but it can be with companies. So Newcrest Mining, Shika. So they, really interesting business actually, Newcrest. Seems to be a lot of comments on gold tonight. I would say I will reserve your questions, Shikar. I will reserve your questions for when we have my friend and fellow investor Luke on the show, who will talk about, I can ask him to talk about gold mining companies and how he thinks about them. But generally speaking, that had recently had a takeover offer, right? So really interesting. So Christopher, government bonds, yes, government bonds inside IAF. So what time is Selfwealth live usually on a Wednesday? It usually starts at 6 p.m. Australian Eastern Daylight Savings Time, says Eve. That's right, Harry. What can I add to IAF Cred, or what is Zaro? Mal, can you just step back a bit? Can you just tell me what Are you saying that what could you add to it? So what, as in what other things could you add alongside it? You could add really anything alongside IAF. Like if you thought, for example, at the moment in like our portfolios at Rask, we have this ETF. Now this ETF is really just because this ETF just takes people's money and invests it in high interest savings account or short-term term deposits. So this ETF from BetaShares, if you invest in it, it literally just has money in a bank account. And people will say, well, why do you do that? Well, it's the ultimate form of like just putting money in a bank account, basically. It's not like a bond because it doesn't invest in long dated interest or contracts with the government. It literally just holds cash in the bank. And then, so we've used this alongside IAF and recently alongside VBond, VBND. And then what will likely happen from this over time is we'll take the money out of this ETF and then shift it across into more bonds and those types of things. We've also used this ETF recently, which is the subordinated debt ETF. So this is an ETF. It's kind of like hybrids, but it's higher up the capital stack. So I'm probably losing a heap of people here. But basically, we've used this recently as kind of like a way to invest in things that look like bonds, but aren't as impacted by interest rate increases. So it's pretty boring, but that's the answer. That's what we've used. Now, we'll probably slowly reduce our exposure to this and go to other things. So what was the other part of that question? Oh, I don't know. It's pronounced Zaro or something like this. So this is a bond fund. I can't remember. I think it's Australian. I've actually looked at this a few times, but this is an actively managed fund. So when a fund says real outcome, I imagine what they're saying is that it's trying to get a return in excess of inflation. Could you explain? A good question, Jason. Good question. So how do you explain the 1 year trend of this? Right. So you see this 1 year trend. That's a good question. So if we go, that's 10 years. I'll go to 1 year. So basically, all this tells you, Jason. What this tells you is that what happens is the ETF accrues interest, right, and then pays it out monthly. So it accrues interest, pays it out, accrues interest, pays it out, accrues interest, pays it out. And obviously, as interest rates have gone up, the shark teeth have got bigger. So that's probably the key thing to keep in mind. No worries, Mel. So as interest rates have gone up, the ETF has been paying out more cash. Now, if you want to, you would want to look at the BetaShares website, because here on this page, I think I've showed you guys this before. When you come down, you can see that the interest rate they estimate, it's just an estimate, is 3.7%. So kind of like what you get from the term deposit. Dale, you've said, what's in the low tofu, please? Geez, we haven't looked at this in a while. So I don't know. I think it's in Selfwealth sheet. There we go. I think it's in here, Dale. So nothing's changed recently, Dale, because we actually haven't done much on the portfolios in recent times. But we can see the list of companies here. Here's probably a better example. So low tofu, these are not 100% accurate. Please keep that in mind, because some of the companies I have to manually enter in the share prices. So I don't know what, for example, this is on Femex right now. I can find that out really quickly as we come to the end of the show. So Femex is $5.85. So I can pop that in here. And the MGOC, which is a Magellan fund, I have to update that. So MGOC is $2.36. So $2 hasn't really changed. Now, this also doesn't include dividends and a bunch of other stuff. And this is, what was the index in? So the index has returned 1.4%. Low tofu is down 2.3%. And high stakes is down 8%. High stakes obviously being a riskier portfolio than the low tofu. But interestingly, I think it was BHP. We didn't fully account for the divestment of Woodside. So keep that in mind. This is actually an interesting illustration of valuation in action, guys. So if we didn't do it on the show, but if we actually went into the company and we actually looked at a full valuation of ARB, what we would have found, this is the 4x4 accessories business. It sells like those bull bars and things. What we would have realized is that paying $41 per share for ARB shares was way too much. And so in a bear market, when things go bad, the highly valued stocks get sold down first. So things like Okta, although that's had integration issues, RPM Global wasn't that overvalued, but it was a tech stock. Catapult was probably overvalued. Tesla obviously has been volatile, but it's come back recently. SQ2 is quite a volatile business, or Block. EnviroSuite has had a few issues just around integration and those types of things. So that's the kind of shakeout so far. I love doing this stuff. So if that's something that we want to do, again, I'm more than happy to do that. So when doing your research, says Michaela, would you also look at total operating expense? If you're talking about a bank, Michaela, yes, the answer is yes. Yes, you would look at operating expenses of a bank. So when I talked about a Commonwealth Bank and I talked about the net profit margin on its lending, so this is just comparing the rate at which they lend out to the money that they get back in. That's literally this equation. Now there's another equation which is operating expenses. So banks also have to pay for rent, staff, marketing, all those other things that aren't captured in the lending. So that's the operating expense line. So that is, I don't know if I'll have it here. A lot of these databases don't have this type of thing, but it would be in there somewhere. Like there would be something similar to it in here. Okay, I can't see it right now, but yes, the answer is yes. I would look at that. Okay, so what's to stop people selling AAA at its peak? Nothing, Matthew. Nothing. Owen, you've said, I would love to have another hour-long call on ETFs for diversification. ETFs for diversification, absolutely. I like the ETF diversification. Are there any other ideas? Before we log off tonight, guys, is there anything else that you want us to cover in the next few weeks? We've got mining, obviously, that's on the list, but we can do ETF diversifications. Moving out of go. Harry, you said you are a member of the Rask ETFs or Rask Core. Yeah, so the ETF, the email should go out tonight at 7:30, I think, and it talks about that. So just keep an eye out for that. You've been buying SPY recently, says Christopher. Interesting. Jenny says, I like the ETF diversification idea. NFTs as part of a portfolio. Jason, you will know that I have an NFT on my Twitter feed. That's as far as it goes. I think I'm down about 95% on my one investment in a blockchain thing. I was just more experimenting with it. So you do like the idea of using ETFs for diversification. And absolutely, we've talked about that a lot. Best combination of ETFs. Yeah, absolutely. So we can talk about that. That's probably, over the past, I've been talking about this for a long time, but and even build a business off the back of this. But I think over the past 10 years, the most dramatic shift that I've seen of any investing, like bar none, the most dramatic shift that I've seen is investors like you and I shifting more of our money towards ETFs. Like I haven't seen this happen before. I can't remember at any time in the past, maybe when managed funds or mutual funds in the United States first came out, maybe there was a big shift like this, but they've been out for a very long time. Even index funds, which came out in the 1970s, it took quite a while for them to get that traction. But ETFs, a lot of people have made the shift to ETFs, which is really impressive. So don't forget about the Crypt ETF. Yeah, the Crypt ETF, that's got to be one of the worst ETFs in recent times. It probably is, to be honest, because of the performance. It just invested in companies involved in cryptocurrencies. How many portfolios should we have, Mike, on the way up? Really, this is like a horses for courses thing, right? Like I obviously can't tell you what to do, but me personally, I have my core portfolio and my satellite portfolio. And in my satellite portfolio, I'll have more individual shares in time. I'll also have maybe private businesses. And in my core, I'll have ETFs and those types of things. Rob chimes in here from Selfwealth, says, Crypt is up 41% this year. Now, I feel like there's a bit of self-interest in you telling us that, Rob. I feel like you're saying, look at my ETF. It's up 41% this year. Is it possible for ETF companies to go under? Yes, it is, Raptor. It is. They're very well audited and very well There's a lot of oversight of ETFs in Australia, but yes, it is possible for ETF companies to go under. It is very common, in fact, though, Raptor, that ETFs close. We've had a lot of ETFs closed over the past few years in Australia. And basically all that happens is they give you a notice to say, we're closing this ETF. You can either sell it now in your brokerage account, or we'll close it and then send you your money back once we've sold the shares. So that's one of the things. So it would be great to know how to build a healthy, diversified portfolio with currencies, countries, industries, type of investment. Good one, Gabby. I can do that. Okay. Can you buy Bitcoin and Ethereum on Selfwealth? Not sure. That's a question for the Selfwealth team. Oh, here we go. Rob said you can buy ETFs backed by them. What are the other questions here that I might have missed? I remember that Rob had them. The crypt couldn't let be the only one with a baddie. Yeah, I'd rather go and throw money at a roulette table than touch crypto, says Owen. Very strong words. Very strong words. Okay, guys. Well, that's it for tonight. I actually finished early. What is happening? What is happening these days? We finished early tonight, and thank you for everyone that stuck around the whole time. So we'll be back in the next few weeks. I do want to get Luke on the show to talk about resources. We will definitely go through how to build a full ETF portfolio, because that is, like I said, I think it's the biggest shift we've seen in investor sentiment and demand for a very long time. It's how I want to invest. Currency hedging. In theory, ETFs aren't a loss-making business model, i.e., they get the fees as long as there's liquidity in underlying assets. It'll be fine. When you sell, you get the prevailing price. Yeah, ETFs are a very good business model. If you're a business that runs ETFs and they're good ETFs, it's a very good business model. Great session, says Mark. You're very welcome. No worries. When you buy the NDQ ETF from Australia, does that internally convert the currency exchange? Yeah, it converts the currency. Rup Kumar, it does convert the currency, but there is HNDQ, which is currency hedged. So currency hedged. Okay, guys, thank you for tonight. Rob and I really appreciate it. On behalf of everyone at Rask, it's right here, and Selfwealth, the team at Selfwealth, thanks for joining us tonight. Hope you enjoyed it. Don't forget, the simple things matter in times of high inflation and times of economic uncertainty. Cutting costs, trying to earn more, and living within your means, having that emergency cash buffer is so important right now. And just like you want an emergency cash buffer if things go wrong, you also want your companies to be in a position that they have cash if things go wrong. And just like you wanting to earn more to keep inflation at bay, you want your companies to be able to earn more by raising prices. So what we're looking for as personal savers and investors, we should be looking for in the companies that we want to invest in for the long run. And that's as simple as it is. And we're just taking what we do and just amplifying it to the size of a company. So thanks tonight, guys. Really enjoyed it. And Caroline, thank you for the kind words. Thanks, everyone, for a good night. We'll see you next week, 6 p.m. AE.